In this section, we will learn how to analyze and record accounting information. In accounting, we use the double entry accounting system. The double entry accounting system has been around for over 500 years when an Italian monk and mathematician named Luca Paciolo wrote a book that explained the basic accounting system. We've already talked about part of the basic accounting system, assets equal liabilities plus stockholders' equity, in Section 1. In Section 2, we will expand upon the basic accounting model. Ledger accounts are the elements of transactions organized into accounts that group similar items together. In a double entry system, a ledger contains the records for a group of related accounts. A general ledger is a collection of accounts that accumulate the amounts that are reported in the company's financial statements, the company's income statement, balance sheet that we looked at in Section 1, and the statement of cash flows. A T account is a simplified version of an account. Here we see a cash T account. This would be a cash ledger account. Cash is increased on the left side or the debit side, and it's reduced on the right side or credit side. All assets are increased on the left side, the debit side, and reduced on the right side, the credit side. The vertical line in the T account divides the account into left and right sides for recording increases and decreases. The account title, in this case cash, is on the horizontal line. The first step in recording accounting information into the accounting system is called the journal. We list journal transactions as they occur in chronological order. You may recall from Section 1 that we had 3 transactions. On this slide, we're looking at the second step of recording the accounting information, and that's posting or recording the information into the ledger. We are using T accounts to represent the ledger accounts. Asset accounts are increased on the left side with a debit. Liabilities and stockholders' equity account are increased on the right side with a credit. Let's look at the first transaction. You may recall that the owner invested $400,000 into the company. Notice that the asset cash is increased through transaction 1 by $400,000 with a debit. Paid-in capital, we previously called this investment by owners, increased by $400,000 in the paid-in capital T account with a credit. In transaction 2, we posted an increase to cash by $100,000. We borrowed this $100,000 through issuance of a note. We owe the money. We have a note payable. You notice we increased the note payable T account with a credit. In the third transaction, we increased and reduced an asset account by the same amount. In this case, we increased the asset merchandise inventory by $150,000 with a debit, and we reduced the cash T account by $150,000 with a credit. As a quick reminder, assets always need to equal liabilities plus stockholders' equity, and left-hand entries debits always need to equal right-hand entries credits. That is the basic accounting model. Assets equal liabilities plus stockholders' equity, debits left-hand entries equal right-hand entries credits. Each transaction affects at least 2 accounts. The process of creating a new T account in preparation for recording a transaction is called opening the account. An account balance is the difference between the total left side and right side at any particular point in time. So let's look at this example. We have a cash T account or a cash ledger account that has a $10,000 increase, debit side, left side, and a $6,000 decrease right side credit side. At this point, the balance in the cash account is $4,000, $10,000 minus $6,000. Assets have left side balances. Entries on the left side increase asset account balances. Entries on the right side decrease them. Liabilities and owners' equity accounts have right side balances. Entries on the right side increase their balances. Entries on the left side decrease them. Debits denote an entry on the left side of any account. Credit denotes an entry on the right side of any account. The accounting recording process goes through 5 steps. We review the documents. We journalize. The journal is called the point of original entry. All transactions are recorded as they occur in chronological order. We post from the journal to the ledger. We've used T accounts to represent ledger accounts. We prepare a trial balance. The purpose of the trial balance is to make sure that debits equal credits, and then we prepare the financial statements. In Section 1, we briefly looked at the balance sheet or statement of financial position. There are 3 primary financial statements: the income statement, the balance sheet, and statement of cash flows. The income statement is always prepared first. The recording process. The general journal is a formal chronological listing of each transaction and how it affects the balances in the accounts. Transactions are entered into the ledger. This process is called posting. The trial balance is a simple listing of the accounts in the general ledger together with their balances. The purpose of the trial balance is to make sure that debits equal credits. Preparation of the financial statements occurs at least once a quarter for publicly traded companies. This is a requirement by the Securities and Exchange Commission, the SEC. The chart of accounts is a numbered coded list of all account titles. Accounts numbers are used as reference in the post-reference column of the journal. Most, if not all, accounting software includes sample chart of accounts based on business type. If you see from the following chart of accounts, all asset accounts start with the number 1. All liability accounts start with the number 2. Stockholders' equity accounts, which are made up of 2 components, paid-in capital, which is the investment by owners into the company. We've discussed paid-in capital previously, and retained earnings are numbered with 3s and 4s. All revenue accounts are numbered starting with the number 5, and all expense accounts are started with the number 6. Note that cost of goods sold, 600, is the only expense that does not end with the word expense. Journalizing is the process of entering transactions into the general journal. A journal entry is an analysis of all effects of a single transaction on the various accounts, usually accompanied by an explanation. A compound entry means that a single transaction affects more than 2 accounts. We will now look at some journalizing transactions. The journal is the point of original entry. This is the first time that accounting information is recorded into the accounting system. The following conventions are used for recording in the general journal. The title of the account or accounts to be debited are placed at the left margin, and the title of the accounts to be credited are indented in a consistent way. The journal entry is followed by a narrative explanation of the transaction, and the post-reference column contains an identifying number that is assigned to each account and is used for cross-referencing to the ledger accounts. The debit and credit columns are for recording the dollar amounts that are debited or credited to each account. If we look at the following 3 transactions, entry number 1, entry number 2, and entry number 3, these go back to our original example. In entry 1, we increased our cash account by $400,000. We debited cash. We then indented, were credited paid-in capital were the investment by owners, and credited that account for $400,000 as well. Debits equal credits. Assets, cash, equal liabilities plus stockholders' equity. Paid-in capital is a stockholders' equity account. In transaction 2, we increased the asset cash by $100,000 with a debit, and we increased the note payable by $100,000 with a credit. Notice again that the note payable is indented. And in transaction 3, we increased one asset, merchandise inventory, with a debit, and we reduced another asset for the same amount, cash, with a credit. Posting is transferring of amounts from the journal to the appropriate accounts in the ledger. We've talked about this a little bit previously. The following example shows how the debit to merchandise inventory and the credit to cash are posted. Columns for dates, explanations, journal references, and amounts in the ledger. So let's take a look. At the top, we have the journal. The information was recorded into the accounting system in chronological order, transactions 1, 2, and 3. At the bottom, we have the ledger account. At the top, we have cash. Cash was increased through transaction 1 by $400,000. It was increased by transaction 2 by $100,000, and it was reduced by transaction 3 by $150,000. In transaction 3, the asset cash was decreased. It is being decreased with a credit. If you look at the very bottom, merchandise inventory ledger account was increased by $150,000 with a debit. This is how we post. Posting transaction 3, you look at the journal reference 3, we reduced cash with a credit, we increased merchandise inventory with a debit. As we've discussed before, assets always equal liabilities plus stockholders' equity, and debits equal credits. Now we're going to expand the stockholders' equity section. Stockholders' equity is made up of two components. Paid-in capital, which is the investment by owners. Paid-in capital, being a stockholders' equity account, is increased on the left with a debit and is reduced on the right with a credit. Retained earnings is the other component of stockholders' equity. Retained earnings is increased on the right with a credit, being a stockholders' equity account, and reduced on the left with a debit. Revenues increase stockholders' equity, credit accounts. Debits reduce stockholders' equity, credit accounts. Retained earnings is the accumulation of net income minus dividends. Dividends are withdrawals by the owners from the company. Revenues minus expenses equal net income. Revenue and expense information is accumulated separately to prepare a more meaningful income statement. The income statement is always prepared first. Expense and revenue accounts are part of retained earnings. A revenue account increases retained earnings, it has a credit balance. An expense account decreases retained earnings, it has a debit balance. Although a debit entry increases expenses, it results in a decrease in retained earnings. So let's look at this transaction. We make a sale on credit for $160,000. This is very important. Under generally accepted accounting principles, we recognize a revenue when we deliver a good or service, not when we receive payment in cash. So we have delivered the good, we have earned the revenue. So in this case, we increase sales revenue with a credit, and we're owed the money. We made the sale on account. We increase an asset called accounts receivable by $160,000. Assets equal liabilities plus stockholders' equity. Left-hand entries, debits equal credits. This is also important. Under generally accepted accounting principles, we have to match expenses to revenues. In fact, the revenue principle, recognizing a revenue when we deliver a good or service, and the matching principle, matching expenses to revenues, make up what's called the accrual basis of accounting. The accrual basis of accounting is required under generally accepted accounting principles, the rules of accounting. So when we purchased merchandise inventory, we had an asset. When we sell that inventory in the process of earning revenue, we have an expense. So we generated a revenue on the previous slide of $160,000. The cost of the merchandise we sold was $100,000. We recognize cost of goods sold, an expense, the only expense that does not end with the word expense, with a debit, and we reduce the merchandise inventory because we sold it. Merchandise inventory is an asset. So we reduced an asset and stockholders' equity by the same amount, and our debits equal our credits. The matching principle can be done in a variety of different ways. The matching of inventory from the previous slide is based on a sale in the process of earning a revenue. Rent is expensed or matched through passage of time during the period that we earn revenue. So if we paid 3 months rent in advance, $6,000, we have an asset called prepaid rent. We haven't used it up yet. So in this transaction, we increase one asset, prepaid rent, on the left side with a debit, and we reduce another asset, cash, on the credit side, right-hand side. And in this slide, we have rent expense. 1 month rent has been used. 1 month has expired. So we debit rent expense for $2,000, and we reduce the asset prepaid rent by $2,000. If you look at the ledger or T accounts at the bottom, we have 2 months worth of rent left over, $4,000 at $2,000 per month. Rent is matched through passage of time and becomes an expense. Depreciation, that we will see in this slide, is the process of allocating the cost of a long-lived asset. We cannot expense the cost of equipment, for example, in the period we buy it because it needs to be matched to the period in which it will be used to earn revenue. In this case, we are going to depreciate the equipment $1,000. Depreciation expense is recorded with a debit, increasing the expense. In this case, we use an account called accumulated depreciation to reduce the value of the equipment. Accumulated depreciation is called a contra asset account. A contra asset account is an account that reduces the value of the asset. So the debit is to depreciation expense, $1,000, increasing the expense, and the credit is to the contra asset account, accumulated depreciation, reducing the value of an asset by $1,000. You'll see the posted entry at the bottom of the slide. This is how we will record the equipment after this transaction in the balance sheet if the cost of the equipment was originally $14,000. Store equipment minus the accumulated depreciation on the equipment of $1,000 result in a book or carrying value of the equipment of $13,000. The book or carrying value is the balance of the account minus the value of any contra accounts. Closing the accounts has two purposes. As we stated previously, balance sheet accounts are permanent accounts. Where we end one period is where we begin the next period. This is true for all assets, liabilities, and stockholders' equity accounts. This is not true for income statement accounts. On the income statement, we look at revenues and expenses for a period of time, and then they go back to zero. We do the income statement first so that we can close those accounts to retained earnings. Retained earnings is beginning retained earnings. Retained earnings, being a balance sheet account, is a permanent account, so where we ended the previous period is where we began this period. So beginning retained earnings plus net income, which is revenues minus expenses of the current period, minus any dividends or withdrawals by the owners in the current period will result in ending retained earnings on the balance sheet. Therefore, the income statement needs to be done first. The revenue expense accounts have to have zero balances at the beginning of the next period and therefore must be closed to be ready for the next period entries. Here we're going to look at the closing process. So sales revenue on the far right side had a credit balance. All revenue accounts are increased or have a credit balance. We close it with entry C1, a debit balance. When we debit sales for C1, we debit a holding account called we credit a holding account called income summary for the same amount. So we debited sales revenue for $160,000 in transaction 1, and we credited income summary in transaction C1 for $160,000. On the left side, we have our expense accounts. They had debit balances: cost of goods sold, rent expense, and depreciation expense. We credited them for the same amount to zero them out. So we credited cost of goods sold with transaction C2 for $100,000. We credited rent expense for $2,000 to zero it out, and we credited depreciation expense in transaction C2 for $1,000 to zero it out. The corresponding entry was a debit of $103,000 to income summary. So now the income summary after transactions C1 and C2, it has a debit balance of $103,000 representing closing the expenses, and a credit balance C1 of $160,000 representing the closing of the sales revenue or the revenue accounts. So now to close the income summary account, to make it zero, we debited for $57,000. Transaction C3, and we closed that to retained earnings, increasing the retained earnings by $57,000. Remember, retained earnings is a balance sheet account. Retained earnings is a permanent account. Retained earnings is increased by net income. In this case, our revenues exceeded our expenses. Our revenues of $160,000 exceeded our expenses of $103,000 by $57,000, increasing retained earnings on our balance sheet by $57,000. Here is the transaction to record the closing of the sales revenue account, C1, debiting sales revenue for $160,000 and crediting income summary for $160,000. At the bottom, we have transaction C2, closing all the expense accounts with a credit balance and debiting income summary. And then on the last slide, we closed the income summary accounts to retained earnings, increasing our retained earnings account.